Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster. This episode features Scott Reardon. I've known Scott for a while, met him through Toby Carlisle and Jake Taylor. Somebody pinged me and they said, hey, you should interview Scott Reardon. And I thought, that dude is right. I totally should interview Scott Reardon. And I pinged Scott and we got to talking and he shared some papers that he has written. He studied the greatest investors, and then he did one on cyclicality of markets in life. I will drop both those in the show notes. It's a very interesting conversation. I had a good time. That said, I had to record it twice because I messed up the first one, but I'm not perfect. Anyway, as far as the cadence goes, I am going to try to do weekly shows. There's going to be times that I can't get it out. I don't want to force episodes upon you that I would not want to listen to. So I don't want to get in this cadence where I get jammed up and then I'm releasing something that I don't like. And I don't really like the idea of having a backlog because I think that some of the conversations get stale. So I'm going to ask you to bear with me a little bit on the release cadence. I'll do my best, but this dude's got a lot going on in life right now, and sometimes getting the pod done just isn't quite the top priority. But I appreciate you all as listeners, and I do want to get stuff out in a regular and timely manner. As always, nothing that you hear in this program is investment advice. You should consult your own financial advisor. Do your own due diligence. This is for entertainment purposes only. Assume I know nothing, and enjoy the show. Thanks for listening. Oh, P.S. I'm probably going to drop some Spotify ads in the show. Hit me up at Bill Brewster TBB on the Twitter machine to let me know your feedback on whether or not the ads were disruptive to your experience, whether or not you found them targeted. I'm kind of interested in using this as a group learning exercise. You know, Spotify says that they have some good ad solutions. I'm a little, call me skeptical, but I kind of want to try it, and I'd love to hear your feedback. All right, enjoy the show. Ladies and gentlemen, welcome to the Business Brew. Thrilled to be joined by Scott Reardon, not Scott Pearson. I don't know what I was thinking there. So we were just talking about offline. You finished your 5th novel?
Yeah, I just finished it a couple weeks ago, and then I feel like I can do absolutely nothing. I'm just totally drained. And then you reached out to me and I was like, this is perfect.
I reached out to you for a second time.
You reached out to me for a second time.
The first time I kind of ruined the conversation. So I apologize to you, even though apparently you didn't think so.
I enjoyed it. I had a great time. I was psyched. I went downstairs afterwards and my in-laws were here and I had a couple cocktails. And I mean, it's the first time I'd ever been on a podcast. I was excited.
Well, here's the second, but it's technically going to be the first.
And as I told you, I'll be on here as much as you'll have me.
Well, I'll have you a lot. I think, I don't know what the issue was. My mind, I had a lot of disjointed thoughts. My wife and I were listening to it in the car, and she was like, you didn't finish many sentences here. So,
do you know what's funny? I was struggling too. I didn't want to admit it, but I hadn't slept the night before. There was some issue with one of my kids. And then, we had a cocktail. And normally when I have the cocktail, I feel great. I feel like myself. Right. Yeah. I just feel wonderful. But that time I just felt a little bit blank.
Well, there you go. So now neither of us are blank. And today I'm drinking water as opposed to bourbon.
I'm drinking water as well.
We've got that going for us.
Yeah.
This may go better.
I thought the last time went fine, but I hope it goes even better.
Yeah. I don't know what it was. I think when I was listening to it, I'm like caught up on this. I'm reading this psychology of intelligence analysis and thinking in bets. And I'm like caught up on my own perception of reality versus reality and how I don't think that I perceive reality as reality or whatever. And there was just a lot of like weird conversation when I listened to it. But I'm glad that you enjoyed it. I enjoyed it too. I always enjoy talking to you. So hopefully people enjoy the listening experience of this conversation.
Yeah, I hope so. And actually, for people at home, Bill and I used to go to investment conferences together before COVID with Jake Taylor and sometimes Toby Carlisle. And this has given us a chance to reconnect.
we met through Toby, right?
Yeah, we met
Because you
at
and
the
Toby used to talk a lot, or still do. But like that's how I think that I met you.
Toby and I lived together in LA for years, and I saw Toby more than anyone else other than my wife. We used to hang out all the time.
And then you moved to the East Coast.
And then I moved to the East Coast. Well, then he had kids. He had kids first.
Mm.
And then that started to make things more difficult. And then he moved out of Santa Monica, and then I moved.
Yeah, kids will do this.
Yeah, but we had a good thing for a while. It was a lot of fun.
So, did you guys do like research together when you were hanging out? How'd you guys meet?
We met through Chuck Gilman. So I was working for Chuck, and Chuck wants to meet everybody. Chuck does proxy battles. And so he wants ideas. And so we met Toby. And as soon as I met Toby, I was like, oh, this guy's going to be my friend. And he and I wound up hanging out, twice a week for 5 years or something like that.
So did you do stuff with Chuck?
Yeah, I worked for Chuck.
I should know this.
No, don't worry about it. My first job in finance was for Chuck Gilman and Ken Schubenstein. So I used to be an attorney, and I hated it and sucked at it, and had loved investing for a long time. And I wound up getting a fellowship at Columbia Business School as a research assistant. And, this was back when there wasn't enough work for law firm associates. And so they'd offer you a fellowship, and they'd give you $60,000 to go work somewhere else for a year. And I jumped on that.
Yeah.
And I went over there, worked for Ken, and then he and Chuck wound up hiring me, and I worked for them for, 2 years.
Oh, that's awesome. So were you doing proxy battles with them?
I mean, I didn't actually get to do one, but I was sourcing them for them and doing investment analysis and all that.
Yeah. Chuck reaches out occasionally. I think he's a listener of the show. Shout out to you, Chuck. Hello.
Yeah, Chuck's a good guy. I love Chuck. He's a very intense guy, but he's a good guy.
Yeah. I first met him at Berkshire a while back. And then, he always stays in touch. He's good at like pinging you and saying, "Hey, let's hop on the phone and chat."
He has a huge infrastructure that makes that happen.
Yeah, well, it's a smart way to do things. That's how you can make sure it happens. So then after Chuck, what was your investment journey like?
Well, then I started a fund, a deep value quantitative strategy. Then from there, I actually wound up creating another strategy that's kind of our flagship strategy right now, which is not quantitative, but it's very, I think of it as systematic, but a lot of it involves non-quantitative factors.
How do you do that? Like what is when you say non-quantitative, I'm hearing qualitative, but like what does that look like?
Yeah, like we first of all, we want to create, it's kind of like when you have a quant strategy, you want to have the fewest rules possible, because the more rules you have, the less robust it is, and the more likely it is that it's been curve fitted. And I actually think that applies to anything. I really admired how Robert Vinall, he kind of does the same thing as a quant does. He has this investment checklist, and he tries to make it as short as possible. And I thought that was just brilliant. I loved how systematic that was. And so we did the same thing. And the first thing we look at is payoffs. We want something where we think it's worth at least 100% more than where it's trading right now. And ideally more like something where we could make 3 times our money in 3 years. And obviously we're not going to hit that every time, but that's what we're trying to find. And then the second thing would be, we want things that are in oligopolies or duopolies, or that have high market share in a fragmented market. And then the third thing would be something where it's has very low obsolescence risk, where I could really, if I had to stand before a judge and say, this company will exist in 10 years, I would be telling the truth, and it would be likely to be true. So factors like that. And we try to really, really stay true to them. And occasionally you have to relax one thing over another, but one rule over another, but that's what we're trying to do, and really faithfully execute it. But to me, it's actually it's a quantitative approach to something that's not quantitative at all.
Where does the quantitative part come in? Just because I'm hearing you talk about like industry structure, relative scale advantages, obsolescence risk, reduction of obsolescence risk, none of that is quantitative. So outside of the payoff structure, like how do you quantify some of these factors that you're discussing?
We don't really do it, but I guess I think of it as quantitative in the sense that it's systematic. I think that's the power of quantitative models and things like that, is that they're very systematic, and you're really trying to stay true to some principle. And so we're trying to use that, but we think there's a deeper reality than can be captured by numbers and quant. But we're trying to, use that discipline to really trying to get the best of both worlds.
So how do you think through, like, staying disciplined, but also having a short checklist? Because one of the things that I've thought about with a checklist that's a little bit difficult is sometimes, if you, like, my perception sometimes is like, if you want to be very systematic about something, the checklist almost has to be insanely long. But like, just to say, no, that doesn't belong here, yes it does, or whatever. How do you focus in on those few key variables, and how long do you think it takes to get to the point where you can?
Well, I guess what really inspired a lot of it was we've put together a database of the greatest investors in history. So we found 85 people who have 20 plus year track records, and they outperform by more than 2.5% a year on average for that time period. So really pretty stellar track records over 3 market cycles. And when I looked at what those people were doing, first of all, they're overwhelmingly value investors. 66% of those people are value investors, which is a pretty incredible thing, because only 5% of the assets, only 5% of financial assets worldwide are managed by, true value investors. So out of that tiny 5%, you get 66% of the greatest. So that it's very, value's very overrepresented, which suggests how powerful it is. But when we looked at what they were doing, we just studied everything we could about these people. And they tended to have very short checklists. They really weren't trying to hit 10 things. They were trying to hit, 1 or 2 things. Not 1, 2 or 3 things.
Was there a commonality with the 2 or 3 things that they were looking for, or did it look different depending on sort of the investment strategy?
Well, just looking at the value people, that's 66% of the total. The value people, I think the number one thing that jumped out is they were looking for things with big payoffs. So, whether that's, higher returns, or, looking for something that's going to return 20% a year indefinitely versus, that the market on average returns 8 to 10% a year. So they were looking for something where it's double the return stream of the market, or they were looking for something where it's, 50 to 100%, worth 50 to 100% more, at least. And what's striking about that is that it's so different from, say, you read a lot of stuff that mutual funds put out, and they do not target big payoffs like that. Not even close.
What do they tend to target?
If you look at, well, there's sort of really 2 portfolios within each mutual fund. It's interesting, C. Thomas Howard has done an interesting study on them. And basically, if you look at the top 10 holdings of a mutual fund, of the average mutual fund, they outperform the market by 4% a year. So this idea that mutual fund managers aren't talented isn't true. They're actually very talented, but that's just the top 10 holdings. Once you get out of that, they typically hold, 50 to 100 things. So they're just bloating up their portfolios with garbage. But even just looking at yeah, that's why they don't outperform. They're smart people, but they're just, they're just using asset bloat to make as much money as possible.
Yeah, that makes sense. And then they're diversifying the potential for outperformance in favor of not getting, basically not taking career risk, right? Because
exactly,
if they don't,
it's interesting. It's kind of an interesting. It's a flawed model. I think it's a broken model, because basically their whole incentive is to have the least amount of alpha necessary to keep you as a client.
Yeah.
And so basically you're giving them money, and in exchange they get lifetime employment from you. That's the hope. You know, so your interests aren't really aligned.
Yeah, I've thought about in the past, like even, Charlie, who I think we'd agree is one of the greatest ever. I've wondered, if let's forget about what he is now and let's rewind to when he's starting his funds. Could I have actually stomached that kind of volatility with him at that time, not knowing he would become one of the greatest? And I don't know what my answer is. I think I'd like to say yes, but I'm not sure that I believe that.
Yeah, I see it the same way. I mean, it's funny. People talk about how irrational clients are, where they'll look at the best mutual funds over a 10-year period and the average client in it loses money.
Yeah.
And people are sort of like, oh, well, clients are stupid. And, certainly some of them are. But the fact is, there's just a huge disconnect in terms of trust.
Yes.
And so it's this situation where they can't trust you. And so they can't be long-term investors because, things change. People change their strategies. All sorts of stuff happens in mutual fund land. It's so that trust issue, it almost makes people do things that are stupid.
Yeah. And I think, it's funny. It's not limited to money management, right? I think that it happens a lot with companies, and often the trust is tested when the performance goes against you, right? And it's like, oh boy, well, now did I really know what I thought I knew? Or, you hit that point where you're forced to look in the mirror and say, do I know what I own? And I think that's the same for a manager, right? Do I know why I actually hired this person? And do I actually believe that they can get through this?
Yeah, it's so hard to find. That's why, I mean, that's one of the reasons why we put together this database is we kind of wanted to study these people as people. When you read their investor letters or their interviews, you sort of see that these are people who are walking through the fire and this is their lives. They're into this stuff.
Yeah.
You take someone like Seth Klarman, he said something in an interview once that really struck me and made me realize just how passionate and thoughtful this guy was, where he was saying he felt that Graham and Dodd were sentinels watching us all and seeing whether we could live up to the principles they'd handed down. That's a guy who feels that he's executing a calling.
Yeah.
That isn't someone just trying to get rich or play the market. Like that's a different game.
Yeah.
And a completely different level of commitment. It's beautiful.
What were some of your big takeaways from the study? I know that when we had spoken previously, you told me that there were like basically two strategies, if I could summarize it. And one was like a deeper value, maybe less predictable business, and the other was focusing on more predictable return streams. Is that fair, or am I butchering that?
Yeah, there's we noticed within the value investors that there seemed to be kind of two types, and it's like what a lot of people think. There were ones who bought high quality things that were inevitables, and they're kind of these islands of sameness, in the ocean of change that you see in the world, and then the second type were the deep value people. It's interesting. Probably only 1% to 2% of assets are managed by deep value investors. It's a deeply unpopular strategy. And yet they're 33% of the greatest investors in history. So they're vastly overrepresented in among the greatest investors. And with them, you see that they're payoff hounds, right? They're sort of like, it doesn't matter what you buy, it's the price you get it at.
Yeah.
That said, I noticed the best deep value investors cared quite a bit about quality, but they were willing to go into some really ugly situations to get it. Like the Chandler brothers, I think are the greatest deep value investors in history. They've made 37% a year for 20 years.
Wow.
Yeah. They turned, I believe it was $10 million into 1 or 2 billion in 20 years. And you can see from their filings that they actually have the money. They weren't running a fund, they were investing their own money, but you can see, what they buy today, they'll buy, a $300 million position in a company. And it's one of, 20 things they own. But they had a strategy that was very interesting because it was so it married the two different schools of value just to the extreme, where they would basically, their strategy was go around the world and figure out where can I buy a country's crown jewel assets at, 1, 2, 3 times earnings. And so they bought Japanese banks after the recession in 2001. They bought them at, they didn't even have earnings. It was just a disaster, but they bought it at basically, 2 or 3 times normalized earnings, and they made, 4 times their money in a few years. But they would do that, in several different places. They went into Russia at one point. They bought telecom assets in Brazil.
So
they were very interesting.
They were looking, it sounds like, for countries that might be having problems or trading at depressed valuations because of whatever reason, but then they were looking for the highest quality assets within that beaten down market.
Yeah, exactly. And they wanted large stuff. It's very interesting. There's kind of this bias today towards small cap and even microcap, where people think, that's really the only place you can get alpha. And I used to think that, back when I was working for Chuck and Ken. And I realized by looking at a lot of these great investors that that's not the case at all. In fact, if you're willing to leave the United States, a lot of times the best thing to buy are the biggest companies, because they're the safest. They're the highest percentage. Gazprom in Russia isn't going anywhere. Would I invest in Russia today? I don't know. But the biggest telecom operator in Brazil isn't going anywhere. And the Japanese banks aren't going anywhere. So they're just investing in these things that are huge and powerful. And in fact, I think a lot of the greatest investors, when you look at their past investments, I was shocked. That's why in our own strategy, we started focusing on oligopolies and duopolies and things with high market share, because I noticed a lot of these great investors, they would buy large caps, and blue chips and things like that when they'd gotten crushed. And the thinking was, it's easy to know. It's, this is something, will it be missed? Absolutely. If this thing didn't exist, it'd be a disaster.
Yeah. Yeah, that makes sense. And you're taking the probability of a zero off the table, I think, right?
Yeah.
If you're focusing on the most important assets. So maybe you're limiting, you're actually truly limiting your downside to, sometimes if there's a probability of a zero, the only way to limit that is by position sizing, but then maybe you're not able to optimally bet your stack.
Yeah, exactly. You're really reducing that business risk. In exchange, you have to take more country risk, and there's really that risk in some of these countries that they might confiscate your shares.
Yeah,
right. That's not some airy fairy thing like it is in this country. In these countries, it's very low percentage, but it's such a scary thing that it tends to depress the values, and in some cases it can create incredible opportunities.
Yeah, that's wild. And what were some of your other favorite investors? Didn't you say, just real quick to close the loop on the Chandler brothers, didn't you say they were down like 70% on a position, and they were just like, no, we're right, we're keeping it?
This is my favorite investment of theirs, and this is why I love them, because they're not like anyone else I know. So they bought Gazprom, I believe it was, and they put in, I think, $1 billion into it, which was something like half their net worth. It might have even been more, and it went down 70%. And the guy, Richard Chandler, said to himself, I could just say, what, I was wrong, but I just don't feel like I'm wrong. I just don't think I did anything wrong. I think my analysis of the company's right. The price just changed. And I think that's so different from a lot of investors today who would be humble, right? They'd say, oh, I realized my mistake and moved on. Whereas this guy didn't. He just kind of dug in, but without being arrogant. And he dug in, and it wound up going back up. And basically he got back to even, which is a huge win.
Yeah, especially from down 70.
Yeah, I mean, I think that was their greatest investment. And frankly, even with their investment in Brazil, in the telecom operator there, that they bought, that stock crashed, and they basically lobbied the Brazilian government. This is in the 90s, to invest in the company. And the Brazilian government said, okay, you can do it. So they put in, whatever it is they put in, $100 million or something. And it went down, I think, another 40 or 60%. So, I mean, these guys invested in stuff that you almost couldn't run a fund doing this.
Yeah, you would get redemptions.
Yeah. Yeah. You get death threats.
Yeah, that's interesting, man. How many of the deep value people have had some element of control and or the ability to influence an outcome? For example, like they lobbied the government, right? I think of Buffett as a younger investor building these stakes in companies and drawing the line on the wall and saying, you got to get inventory below this line. Like he was not a passive deep value investor that was just waiting for the market to become a weighing machine, right? He created a lot of catalysts. Is that something that you saw as a commonality?
In my experience, they were doing almost nothing to influence operations. They would, in the case of the Chandlers, they would, if they could get it, they would want a seat on the board. But they really weren't doing much beyond governance, wanting to make sure there was good corporate governance. And among the others, I saw almost nothing where someone was getting activist with something or getting actively involved in the operations of the business or anything like that. I was kind of surprised.
Yeah, that is surprising. It requires a real belief that the weighing machine will work. One of the things that I have wondered a little bit about value as a factor, especially among smaller companies, is, with private equity everywhere now, at least in the US, and likely going worldwide, have some of these, like, the leftovers. Why is a company leftover is kind of the question that I'm asking myself more and more as I look at some of the cheaper, smaller things. It's like, I have to think. The rebuttable presumption to me is almost that it's been diligenced if it's under, call it $1 billion.
Yeah. Yeah, I get that. I mean, that's certainly a concern. Frankly, a lot of the stuff we see that's smaller has been owned by private equity or they tried to own it.
Yeah.
It's kind of interesting and it's just kind of been churned. But that's the smaller stuff.
Yeah. I was having a conversation with somebody who focuses on smaller, I think. Well, I know, but he told me, he said, if you really want to focus on smaller, maybe start at like $1 billion or $2 billion and don't go like real small because the return on brain drain is probably not worth what you think you're getting in opportunity. He said there's plenty of inefficiency in that $1 billion range, and they're like real businesses.
Yeah. I mean, I think that's great advice. When I first started investing, the place where I got burned the worst was in microcaps.
Yeah. Well, easy to buy, hard to sell.
Oh yeah. And I've never forgot it. The worst investments I've ever made, were in microcaps and frankly, something that I'm a little embarrassed to cop to now. But at one point when kombucha got really hot, I almost bought some shares in Reed's, which made kombucha. There's this whole thing. Yeah. There was a write-ups on Value Investors Club. It was like everyone was like, kombucha, it's this new thing. And guess what? A lot of these companies are trading at value prices. And I wound up speaking to a friend, and he had looked at it too, and he talked me out of it. But it's just been a disaster. And looking back on it now, it's such a stupid idea. I can't even.
I don't know.
I don't even know what I was thinking.
I mean, beverage is very sexy. Beverage is something that when it works, it can work in a big way. And Celsius is probably the current beverage. But I had a successful investment in National Beverage following a short report there. Beverage, it's interesting. They've got high margins. There's a real takeout potential by some of the big guys. I could see it.
Yeah. I'm glad.
How did you approach the conversation with your friend with an open mind? Because sometimes that's hard if you like an idea to discuss it with somebody and be open-minded enough to say, you know what, this person's got a legitimate point and I should stay away from this.
Oh, I was 100% receptive to what he was saying. The other thing is he makes a good point. He's never seen a microcap actually fulfill its promise and become, a mid cap or a large cap, right? That's what everyone's always all about. They're like, oh no, this thing's going to be big. It never happens.
I got to look at XPEL. XPEL's done a good job, at least on a market cap basis. But yeah, I think it's definitely the rare bird.
It's vanishingly rare, and I don't know. It's something that just seems to incinerate people's capital. So we don't invest in stuff typically that size unless there's something really special about the business.
I think something about the allure of small caps is it's one of those things that should make sense that they can grow a lot, right? Just, you get yourself law large numbers. What's the base rate? The big winners can come from this. But I think the base rate of really bad outcomes is quite high in that relative to the larger stuff also.
It's really high. It's really high. And I don't know, a lot of the people involved with them too are a mess.
Yeah.
You get some of these CEOs running their fiefdom, and these guys some of them are just nuts with the microcaps. I mean, it's a completely different world.
Yeah, and then you've got this situation where you're relying on somebody. Like it's weird to have a microcap in the first place, just like sort of in general.
Yeah, why are you tapping the capital markets?
Yeah.
It's very odd.
Yeah, you need some good answers to these questions.
And there usually aren't good answers.
Yeah, well, I think so. I guess that goes to a little bit of what I was trying to get at. So I think people see good answers because they want to believe there are good answers there, but not because there are actually good answers. Does that make sense?
Oh, yeah.
Yeah. It's the allure of getting rich, I think.
It's funny, on Value Investors Club, which has all these people who are very sober, serious people. I've noticed that every once in a while, every few years, someone posts something, where it's like, this company, this microcap has just created a new non-nutritive sweetener, and they're about to sign something with Pepsi or something like that, where there's some story and it gets some really high rating and a huge number of ratings, and people pile into this thing and the stock shoots up, and it's all these sober value investors. And then what inevitably happens is that the person who originally posted the idea gets so much shit from other people as it does not work out, as the story slowly deflates, that they never post on the site again. This is a repeating phenomenon.
I can understand that.
But it's almost like just ignoring the money and everything. It's really you're betting parts of your life getting involved, so wrapped up in this stuff. But it turns so ugly and bitter. It's not worth it.
Well, and I think part of the issue too is with the microcap area of the market, there is no liquidity when it goes wrong.
Yeah.
So people are like truly trapped and screwed. Whereas, at least if you're pitching something like Netflix and it goes wrong, anyone at any reasonable size can get out.
Yeah.
Like quickly.
It's
microcaps are not that game.
Yeah, it really is an advantage in business just to have scale to be big. But it's funny. It's such a simple thing, but it's huge. It's huge. I mean, you can even see it. We've invested in a company that does aseptic packaging, and they're the third biggest player. And if you look at, the second biggest player, which is a public company, they've just got far better margins. And no one knows what the margins are of the top player, but they've got to be incredible. But it's just that those scale economics are so hard to beat.
Yeah, I've been spending some time thinking about. I spend a decent amount of time thinking about media, but you look at Netflix, and I just brought it up, but it's interesting to see Warner Brothers is now pivoting, and they're going to sort of pursue a different strategy. There may be a world where Netflix has a real relative scale advantage. I don't know. We'll see. It's there's a lot of alternative worlds that exist. What I've been working on seeing is, I used to think that Netflix would inevitably have that dominant position, And what I'm trying to get myself to realize is that was the first lens that I used to look at things through. What does that lens make me blind to today that could cause me to miss a world where like Apple and Amazon actually do have scale, or Warner Brothers and NBC and Paramount are end up merging, and now you have like a oligopoly, but it's got relatively low barriers to entry, maybe big barriers to distribution. I don't know, but what I'm going through is just like trying to remind myself that the original lens that I saw something through is going to color the lens that I see something today through, and how to avoid that analysis. I think maybe the answer is you wait until it all shakes out.
Yeah.
And then maybe you make a little less return, but your return stream is more defined.
Well, taking Netflix as an example, is that something that you've done a lot of work on? Is that something you're considering owning at these prices?
I would be open to owning it at these prices. Yeah. I don't know. I'm a little uncertain on the payoff risk reward structure.
Yeah.
But yeah, I think look, it's obviously better to own here than it was at $600 a share. Right. But yeah.
Netflix for me is one of those things where it's just, I haven't done a ton of research on it, but when it crashed, I looked at it, and it's just surprising to me that their free cash flow is so low, given just how much market share they have and how dominant they are. I don't know their exact market share, but just their mind share is so big. And yet they seem, the content costs and are so big that they just can't get positive free cash flow.
Yeah, I would I guess that one of the biases that I think about this through is I would just say yet. And I think that when you're rewarded for doing something in the market, which is driving sub growth, I don't know how many internal conversations you're having about cost. And now they've got a large recurring revenue top line base, and now maybe cost matters. And I think that's an easier problem to solve than it is to get to that top line.
It's interesting because Uber is kind of in a similar situation where, they obviously haven't turned a profit, but it would seem, they occupy a very easy part of the ecosystem, right? In terms of getting a ride and all that, they're doing the easiest part. The software is the easiest part. And it would seem like they should be making a huge amount of money, and they're not. But I mean, if they ever figure it out, it seems like it would basically be a value stock.
Yeah, I need to figure out more about that company. There's one investor that I know that I have a lot of respect for that's long that, and I should probably get more curious about why. Sometimes I get bogged down in just covering the same stuff over and over again, and I think that one, I guess it provides a sense of comfort, but I think the downside is like I miss a lot of potential other things. Obviously, there's a trade-off in how you allocate your time, but like I don't know that the next piece of news on whatever content strategy Paramount, right, is pursuing, like I just, the marginal benefit to my life of covering that, I think, is like pretty low relative to trying to figure out stuff like what's going on at Uber and being able to zoom out more and saying like, that's not even an industry I really want to mess with right now. This is an industry I do. How many in your and maybe the answer is none, but how many investors that were really good were focused on consolidating industries? That's something that I see Buffett and Munger talk about a lot.
I didn't find it a lot, but it did seem like, people wanted higher market share. That was a big thing. They wanted those solidified, entrenched players in the industry. That came out, but I didn't find a lot specifically on consolidating. It was also tough to find that level of granularity for a lot of these people. Some of them lived in the 1930s and 40s or 50s and 60s, and you're getting stuff where they weren't, the language people use today to describe investments is so much more sophisticated and rich than it used to be.
Yeah.
There's so many people who know so much about investing right now. It just sounds, people talk about it in a much richer way. You even look at investment write-ups from 20 years ago, and they're so much shorter. They're shorter and more succinct, but they're just far less kind of intellectually dense than you see today.
Yeah.
It's a different world.
You know what I think is kind of interesting is like I was reading, gosh, I think it was I guess it was only like 6 years old, the Graham and Doddsville. Maybe it was only 5. I don't know, but they were talking about credit acceptance, which I know is like it's a subprime lender for cars. For those that don't know, and it's very controversial. Shorts have gone after it a number of times, and I've talked to like financial investment, like an investment banker that covered financial entities, and he was like, I know their results are incredible, but I can't figure out how they do it. But that's a company that over the years, as you read the pitches, they really haven't changed, and yet the returns of the stock are quite good. It's almost like I don't know. It's like some of these businesses are truly endowed with winning.
Yeah. I mean, that's an interesting business. And to the banker's point, we actually owned it years ago. And I would run through a sample loan for them, and I couldn't square the economics. And I actually it really just, I could not square it. And I wound up connecting with somebody who walked me through it, and I'd be happy to send it to you. But he helped me figure it out. And I actually think that it does make sense. Just looking at it at the average loan level, that the economics do square. I was thinking they were somehow screwing over the dealers or something. Something wasn't making sense, but I don't know. This guy helped me, and it was the only reason I was able to kind of figure it out. And we wound up buying it, and it was a decent investment for us.
Yeah, it's an interesting space. I don't know. I had a conversation with Tyrone V. Ross when this podcast started, and I used to have such a natural aversion to subprime, and now I realize, I guess how I would say it is, it's a shame that it has to exist, but it does have to exist. And if it didn't exist, there's a larger shame out there, I think, that's reality. So, it's one of those unfortunate consequences of life.
I feel the same way about the company. I've sort of been torn, are these people actually helping, people who are lower income, or are they, being pretty rough with them? Because a lot of the stuff, they have key locks and stuff like that on the car. That's pretty ugly stuff.
Yeah.
And yet at the same time, the company was founded because, certain people just couldn't get a car. They couldn't get to work. They couldn't function.
Yeah. And if you don't have the key lock, then what is your then what do your loss ratios actually look like? And then what do the interest rates have to be to the person that does want to make the payments back? Right.
Yeah.
Like, I mean, I don't know. The older I get, the more I realize there's a lot of gray area in life that I used to think I had answers. Now all I have is questions.
I mean, I don't know about you morally, now that I'm middle-aged, I'm kind of like exhausted.
Yes. Like, I'm super apathetic to a lot of moral debates, which makes me feel horrible to say out loud. But I used to have strong opinions, and the more that I've learned, the less strong my opinions have gotten.
That's how I feel too. I feel like I've just hit a point where I don't know anything anymore.
Yeah.
Almost. It's, you see these pat answers to things, and it's just, you just see how much it falls short. And this stuff is so complicated and hard. It's, I don't know what it is. I really do feel like, when so many of your cherished beliefs have not panned out the way you thought they would, and all these things that you thought were true were maybe half true, it really, I don't know, it strikes at something deep in you, and you just kind of wonder, what is true out there?
Yeah.
It's very hard.
Well, I think what is true is thinking in terms of probabilities, and rather than like being certain that subprime lending is bad, maybe training, myself to say, look, I am almost never going to be more than 70% sure of anything. So if I
Yeah.
say I'm 90% sure, that's really about 65% sure, right? Or 63% sure. So my highest degree of confidence on anything is 55 to 63%, which
That
is kind of a sad way to live because it leads to boring conversations. But I used to think I like knew things, and I just don't know that I knew anything.
That's how I feel. But I guess it's on the one hand, it's exhausting and it's difficult, but I feel like there's something good at the end of that.
Yeah.
I think when you look at someone's life, people have such certainty and, such big hopes and dreams when they're younger. And, there's now all these statistics out on human happiness across a person's life, and people are the most unhappy in their 40s.
Well, that's because they have no time to themselves. That's what I'm convinced of.
I think that's a big part of it. I think the other thing, though, is, as a young person, you set the bar so high that it could never pass over that bar. Your expectations are, it's almost, it's almost a tyranny how high they are.
Yeah.
And I think when you go into middle age, they come down, and that's very painful.
Yeah.
It is so painful to have them come down. But then I think when you come out of that, I think you have a more realistic view of things, and you're more appreciative of what you do have. And I think there's some, it's almost like you're just burning stuff away in a fire, and what's left over is the good stuff.
I like how you said that. When I was talking to William Green, and he had mentioned, I forget how the story goes. I think this is the second time I'm bringing it up on a pod, and he brought it up. But, these great investors, they ended up having these personal lives that were sort of in shambles, right? And, or if not, I shouldn't say in shambles, but like, I don't think that people would want their personal life. If you asked a young person, do you want to raise your family this way? They're not going to say yes.
Mm-hmm.
And I kind of wonder, I said that I'm only 70% sure of anything. I'm 90% sure that the time that I put in with my family, I'm not going to regret. And I am 80% sure that if I have to live in a smaller house down the road because of it, I'm going to be okay with that. And I'm somewhere between 80 and 90% sure that my kids aren't going to blame me for that decision. So I guess that I used to value things that I now perceive to be sort of like being right. I used to care about. I don't fucking care anymore.
No, I don't either. I just avoid it.
Like, if somebody else wants to be right, fine.
Yeah.
And I don't know. It's weird how life has shifted in that way.
But I think what you're talking about is, I feel the same way. And I think what you're talking about is I think demonstrates the power of, seeing so much stuff that you once cared about and once gave you so much, seeing it kind of just burned off, and what's left over, what's left over, your kids.
Yeah.
Right. If you think about it, if, an asteroid were heading towards planet Earth right now, what would you do?
Yeah. I'd just hang out with my family.
Yeah. I'd call up some people and say goodbye. And then I'd hang out with my kids and, I don't know, try to make some sense of it with them, but just spend time with them.
Yeah.
But it's
yeah,
like,
that's right.
So much of that other stuff is, but to your point about percentages, right? That the low percentage stuff is just gone. Like, that is fucking gone. But what you're left with is the high percentage stuff, your kids, your, doing stuff with your spouse.
Now, when it comes to work in the markets or whatever, I do enjoy competing.
Oh yeah.
But I have realized that I don't enjoy it nearly as much as some people. Some people are obsessed with it.
Well, the funny thing is there's competing and there's competing. And it's funny. I was talking with my dad the other day because my son is going through this thing where he's, trying to decide whether to do, travel soccer or travel lacrosse. And lacrosse is one of these things where you have to get plugged in early, or you're on a lower track. And my wife and I have been sort of going nuts over this and wondering what kind of people we've turned into.
You've turned into the normal American parents at this stage of life. My friends and I were having this exact conversation.
It's terrible.
Anyway, continue.
Well, I was talking with my dad about it, and he was kind of making me feel like shit for caring so much. And he was saying, how much is your son picking up on how much you guys care about whether he's, one of the best at something or really good at something, and how much of that is coming from him. And, I was saying actually a decent amount's coming from him, but a lot is coming from us. And he was saying, well, does he know that there's anything else, out there other than winning? So basically, when they're playing a game, is there something else out there that's more important than just the outcome of this game? And for a kid to know that and understand that this is just a part of something much more important, his life and his development as a person. And I guess bringing it back to the competition thing, there are competitive people and there are competitive people, right? There's competing where you're just trying to like kick someone else's ass and be the best and have that feed your ego. And then there's, I think, doing more like what Seth Klarman is doing, where you're just trying to be thoughtful and you're really trying to stay true to first principles. And you do want to win. You do have that. But it's by doing that you win.
Yeah.
And I love the latter. And I think the first is just scumbaggery.
I guess I'm going to push back on your dad a little bit and say that we don't want to have a society where playing sports isn't about winning.
But he's not saying that.
I do think I know, but I think like your kid, my kids are going to step on a field and think like winning is the goal here. Right. And then, but I will say one of the happiest moments in my entire life was an 8th grade football game that we played and we lost. But the amount of improvement that we showed from the first game that we played to that last game, and the way that we came together as a team and how we all executed what we could execute to our best ability. That was one of the highest moments that I remember. So I guess it's not all about winning, right? I mean, there is something to be said for, like, we were just flat out not going to win a football game against this team that we played. Like, we just didn't have it.
I mean, in life, it pays to be a winner. But
yes.
at the same time, if, as a hypothetical, you take two athletes and one of them is, say a great quarterback and the other one is, just decent, just because the one of them is great, and not that you're saying this, but just because the one of them is great, it doesn't make him a better person than the other one. We all we all think there's some larger reality there to it. And my dad's point was, me, Scott, I'm being kind of a little shit about the whole thing, and it's not just totally about that. It's,
dude, I'll tell you what though, I wish that that youth sports were a publicly traded stock. I would buy it all day long. It is such a racket.
It's such a racket. Lacrosse,
it's so expensive.
So one fall season of lacrosse here in Fairfield County is $2,000.
Yeah, they have a fucking stick and a ball. Like, what are we charging for here?
It's crazy. It's totally crazy.
It also seems to be the sport that my peer group has leaned into, as it's the one sport that our kids, I guess, still have a chance to be moderately good at.
Totally.
It's like, I remember when lacrosse was still something sort of new, and now I've got all my friends have their kids in lacrosse. It's like, oh, this is just the next thing. I got to get my kids on the next thing.
Yeah, you do. I don't know what that is, though.
I don't either. It's probably going to be like dart throwing or something. We'll make that professional.
My parents are the type where they're all about, they'd be so mad if they saw this, but they're all about getting into a good college. And so they made my kid's sister play the harp for years.
Yeah.
And
that makes total sense.
But she's forgotten it. They've gaslit her, and she's like, oh no, I loved the harp. And she hated the harp. I mean, watching this kid, it was like watching a kid in a factory or something, like her little fingers working the strings on the harp, just miserable. And it's like just this sham thing she's engaging in to get into college. But my dad was telling me the other day, he's like, you got to get Scotty into fencing. That's how you get into college. And I was like, yeah, we have other priorities. We would like him to not be a virgin when he's 30 years old. So that's more important to us than him getting into Harvard. And he was just flabbergasted. He was just like, how could you say that? So
You don't think that fencing is a hot thing to tell, whatever you're interested in about? That's funny. Oh man, that floored me. That was a good joke. It's also true, by the way. I've got a kid that, I don't know that he's, actually, I shouldn't say this because we bribed him with money. We said, if you can do your spelling by the time that school starts, we'll give you $200. I have never seen this kid work so hard in my life. And I never thought that I would be that parent, but like, I don't give a shit. I will pay this kid for every single A. And I just hope that I don't set the bar too high because he's going to keep asking for more and more. But like, I used to see kids that would get paid for grades, and I think I was jealous of it. And my parents never motivated me in that way. Now that I see what it's doing for the child that I'm motivating in this way, I'm 100% going down this road.
This is very interesting. I might try this myself.
Oh, dude, I mean, he is a machine at working at his spelling right now.
What does he want to spend the money on?
He'll walk by me. He'll be like, "You're going to owe me the $200." And I've never seen this like side of him. And I'm like, okay, dude, I will happily pay it to you.
You know what the funny thing is what he's doing is in a sense smarter than just blindly wanting to learn whatever they teach you.
Yeah.
Right. He I'm sure he's got some very interesting ideas for how to spend that money.
Yeah. Except part of the problem is he's telling me about this stupid G-Wagon he wants on Roblox.
Oh, no.
I was like, you're going to take some of this money and you're going to buy a digital G-Wagon that you're going to get tired of this game in like, whatever, 3 weeks? This is stupid.
We went through that. My son played this game where they took dinosaurs and they would put guns on them and just shoot each other. But the dinosaurs cost $100, some of them.
Yeah, it makes no sense.
It's just insane.
Mm-hmm.
It's totally insane.
But kids like it. I mean, I guess I did stupid stuff like that too, but I'd like to say I didn't.
But I love that. I love that you guys are doing the paying for the grades. I'll admit we've done something similar.
Child younger than him blew my mind, read Winnie the Pooh, and like, how are you going to give one kid some money? So what? And then not the other when the other is naturally motivated. So now what I've ended up doing is that kid got $50 for finishing the book. He's younger, so 50 is like feels big, and he gets another book.
I love it.
But I can't spend $50 per book. Like, this kid's like just churning through books. So I got to get some deflation in my life.
Yeah. Yeah. Now the next thing is can you start paying your wife? Can you bribe her too?
I think that I think my wife and I are paid plenty. I think we need to pay ourselves less. We need to reduce the consumption to give the money to the children.
Okay.
I think that's the best way this goes.
Okay. My wife and I have started, we do these things where we're kind of gambling against each other, where I'm like, she'll be like, if you cannot raise your voice with the children for, like 24 hours, I'll, take you out here. Or like, we'll play, instead of playing like strip poker or something, we'll play poker, but we're playing for, you need to take me to Cape Cod for a weekend.
When's the last time you guys played strip poker? That sounds fun.
Yeah. No comment.
Yeah. Tuesday.
No, not Tuesday. Not Tuesday. It's like,
life changes. Anyway, where were we? We were talking about these great investors who never talked about things like this, I don't think.
Actually,
and that's a shame. They missed out on stuff.
Actually, let me say something about strip poker. Now I don't want to play strip poker with her because I don't want her to see me. I don't want her to see me, just sitting there with my shirt off. It's not as pretty a sight as it used to be.
I do get that. I've stopped. We're 8 days into being fully dry here, so I'm not saying that I'm stopping drinking. But the amount of sugar that I can avoid and the weight that is coming off is quite nice.
Yeah. It's impossible to lose weight when you're drinking.
I think so too, especially at this age.
Yeah.
It's a good lubricant for social activity. But once you hit the age that I have hit, I think it's time to start worrying about how fat you're going to be when you're older.
It's awful. I hate it because everything I love to do makes me fat.
I understand.
How old are you?
I definitely understand that. I just hit 40.
Oh God, I'm 42.
I think
40 is a difficult birthday.
Yeah, I don't think I took the birthday that tough, but I definitely think I've got signs of midlife crisis here, and it's manifesting itself in apathy,
which I still argue is wisdom.
Yeah, it could be, but I've gone kind of fully fuck it mode.
Yeah, I actually think there's something. I get it. I've hit that point too, but there's something powerful about that.
I think that's probably right. I also had some big life events that kind of like, I do think that I've done things over the past 3 years that have like, I used to run from a lot of insecurities, and now that I've taken care of those things, I'm kind of like, okay, I'm actually a man and I can be proud of like what's going on. So now I just kind of don't care as much about things that I used to feel like I guess used to be insecurity driven at their core.
That's interesting because just in, you and I have hung out. I don't pick up on that at all off of you. You seem very confident.
Well, it's a nice shield, but it's not true. But I'm getting there, or have gotten.
Okay,
if that makes sense.
Yeah, I get that.
Some of it was I don't know. For a while, like I wanted people to like the ideas that I had. Some of the ideas have turned out to be really terrible. So that hurts when you're public and people are listening and the ideas are terrible. But now I just don't really care if people like the ideas, if that makes sense. It's more important for me to like the idea than other people to like the idea.
Nobody likes my ideas. I never get much traction anyway. I never did. No one seemed to care. No one wanted to hear it.
That's probably a good thing,
I guess. I mean, even this investor study I did, I was all excited about it. And I try to tell people about it and their eyes glaze over. It's like this means so much to me. And they're just like, oh yeah, that's nice. And I'm like, no,
how much time did it take you to do it?
I spent years doing it.
How many years?
A couple of years.
Yeah, that's a lot of work, man.
I didn't only do that. I would just,
Yeah, but it was a passion project.
Yeah, exactly. And to me, the results were life-changing to me, but not to anyone else.
So okay. So you went into the project more of a deep value guy, and it sounds like you've come out of it more of a industry structure, potentially GARPy. Is that fair?
And not really GARPy, but I mean, it's so hard to get those where you can, make a big payoff on a lot of those.
Yeah.
So many of those are just so well priced that even when they're cheap, it's really hard to get a big bargain there. But yeah, I've definitely come out of it more. I when we were doing the quantitative deep value stuff, we didn't care about the quality of the business at all. And now I care quite a bit.
I'm personally intrigued by these ideas where you have a good business under a crappy business, and the good business is less than, call it 30% of the crappier business.
Mm-hmm.
Because my fear with some of those like really good businesses, to your point, is that there's nothing that I am going to discover about those business. I mean, there's very few insights that I'm going to have about those businesses that are like, yeah, the market thinks it's great, but I think it's awesome, right?
Mm-hmm.
Or the market thinks it's awesome, and I think this is the greatest business that's ever existed. I do think that there's something to be said about the businesses that are, I'm thinking of a couple that I own that they're smaller and they've got engines underneath them that I'm excited about. And I think that either the market underappreciates it, or even if the market does appreciate it, I can see why my returns are going to be connected to the underlying business creating more value in the future, rather than saying this stock is mispriced today and I'm waiting for a re-rating.
Mm-hmm.
And maybe that's a flawed way to think, but I do think that it's a little bit of a more stable premise where you're looking for like true economic value added over 3 to 5 years. I think that's more aligned with the way the world should work. Obviously, price paid matters.
How focused are you on price paid? I sense you're more focused on the quality of the assets. And
yeah, I spend a lot more time on the quality of the assets.
when
But I mean, I care about price. I now, in retrospect, it may not have worked, but I mean, I laid down a bet that I took the long side of a curate short Zoom trade in, 2021.
Mm-hmm.
So I obviously believe entry multiples matter,
Mm-hmm.
but I don't like to comp, across industry necessarily. Would maybe be a decent way to say it. Like, I don't think that just because something is priced at a 15% free cash flow yield, it's any cheaper than something else at a 4% free cash flow yield with no other information known.
Right.
If that makes sense.
Yeah, no, that makes sense. It's actually, it goes back to a discussion you and I had a few years ago about deep value investing, where you were saying, look, I get a lot of these things, have a high free cash flow yield, but with a lot of these, there's a low terminal value, and it's known. It's pretty high percentage. And I didn't really have a good answer to you back then, which bugged me. But I have thought about it, and I actually think the best deep value investing is the kind where you are investing in something that has a decent terminal value to it, and where you can find that. I mean, occasionally the other kind is worthwhile, but you have to be compensated for that, right? It can't just be like a 10% free cash flow yield. It's got to be huge, and they have to be distributing the cash or something, which they usually don't do. But what you described is what actually kneecaps a lot of would-be deep value investors, where they are truly buying garbage, and it hurts them, it burns them.
Yeah, and I think the other thing is, I've put this out on Twitter a couple times, and people hit me. I prefer, if you have specifically with commodity companies, because I think they're so hard to value for both management teams and investors, which may make them in the too hard pile, which I'm sympathetic to. But if you have a high free cash flow yield on a commodity company, I far prefer a dividend to a buyback. And people will say, well, you can sell pro rata into the buyback. I think that creates some timing issues. And I've seen too many examples of management teams turning on the buyback spigot at the tops of markets and turning it off at the bottom of markets to think that a buyback is actually going to be executed through the cycle. Whereas, like, if you are giving me a true cash back, and it doesn't have to be a recurring dividend, right? It can be a special dividend. I'm fine with that. But like, cash back off the table to me, even though theoretically less tax efficient, is probably what I prefer in those setups.
Yeah, it's interesting
to reduce the terminal value risk, because every buyback, all you're doing is you're like increasing your relative percentage of terminal value risk.
Mm-hmm. That's interesting. I mean, if you look at the market historically, dividends are actually a far better proxy for free cash flow than what people say free cash flow is. If you like, do you know you probably know this, but backwards and forwards, but the free cash flow yield plus growth equals your expected return. Have you seen that?
Yeah, plus or minus whatever multiple fade, right?
Yeah, but it's actually something Buffett uses.
Yeah,
where he's just he's kind of valuing it like a bond, except the coupons grow.
Yeah, it's roughly bond math. Yeah,
but it's interesting if you look at the market using that. If you take the dividend yield of the market, the average dividend yield is I think about 3%, and then you add the average growth rate, which is 6% for earnings, that gets you 9%, which is actually the average market return for the S&P 500. So dividends are actually a really good proxy for free cash flow, and arguably better than a lot of these models you see out there that forecast giant free cash flow in the future.
Interesting. I think, I mean, just like riffing on that topic, I think part of the reason maybe, I mean, what we're really doing when we're buying like minority interests in a company is like, you're really trying to figure out what is the free cash flow to minority common equity, and a dividend. I'm going to sound like such a boomer here, but a dividend at least, I don't want to say guarantees, because it can always be cut, but it does promise, at least in the near term, some true hard cash delivered to minority common shareholders. I think that's an underappreciated. It reduces agency cost, in my opinion, and I think that it's an underappreciated discussion.
Yeah, agreed. I mean, so much can happen between the lip of the cup and that possibility. Those potential risks so frequently become actualities.
Yeah, it's one thing that I also think growth investors tend to benefit from is a reduction in agency cost. I do think that they increase the probability of overpaying risk, but maybe they would say that that's a risk that they're paid to mitigate, right? So that's within their control, and at least if you're in more of a growth company, the risks that are outside of your control, I'm sympathetic to an argument that they may be lower.
Right. They almost have to they have to reinvest in the business.
That's right.
So it's like they're stuck.
Yeah, and everybody's kind of on the same page.
Yeah, and you want them to be. Right. It's kind of like the discipline of debt when it comes to private equity. It's like you want there to be some strictures there where they can't just do whatever the hell they want.
Yeah. Ironically, you get that in public markets, and it creates a lot of distortion in behavior. I shouldn't say distortion in behavior, but you see how some of these levered equities trade, and it's just like, man, they fly around.
Yeah.
For somewhat good reason and somewhat not good reason. I don't know.
Something that has been a blind spot for me has been capital allocation. It's so hard to figure out, and it's destroyed so many potential good investments.
How so?
A company being overly conservative and issuing stock in order to capitalize themselves, and they don't really need to, but management cares more about making sure they're way under levered, but it just completely decimates the upside in a stock. And a bad acquisition, things like that, where it just dilutes what's going on.
Yeah. I think the person that has helped me a lot think through this stuff, and I need to implement more and think less, but is this dude Mike P. He's now at WCM, but he used to write under non-GAAP, and his framework of looking at proxies for clues of how management is going to be incented and when they think that they're backing up the truck for themselves, and how you can get like a clue from that. I think that's so important, because to your point, like if you're a company, as you're talking, that's ringing out my head is Evlara, who just agreed to a purchase price that I think most of the shareholders are pretty upset with. And it's like the management didn't have any skin in the game. Like so if you have a management team that doesn't own a ton of the equity, and they do draw a salary of, call it $1 million a year, and they get some options that they're going to rebase down if the stock goes down, like, okay, issue some shares, right? And we'll protect our means of living. We'll continue to draw this salary. No one can really, it's not going to be a breach of fiduciary duty to raise capital through equity, right? And like, the minority shareholders just kind of screwed at the end, but that's not really our problem, I think, is the attitude of a lot of management teams.
Oh, I think, yeah, definitely.
And it's not even malicious necessarily, right? It's just an incentive issue.
It really is. It's not malicious at all, but it's just, I don't know. It has a malicious effect, but it's, they don't, I mean, it's sort of, everyone's just trying to get their own. And
yeah, that's right.
And it's so rare where the interests line up. And when it does, it's special, but it's just so rare. Everyone's just trying to do their thing. I'm constantly struck by that.
Yeah. How much, I mean, I would love to sit down with some of these great investors and ask them, how much did you think about incentives, and stuff like that? I suspect a lot.
Yeah, I think they did. I think they did, but they were willing to buy, excuse me, even when it wasn't there, where they didn't know.
Yeah, that's tough though. That's the old Buffett. You can't make a good deal with a bad person.
Yeah. But I think,
or bad incentives rather than personalizing it, right?
I think if it were obvious, they probably wouldn't go with it. But in a lot of these situations, it's just an unknown.
Yeah.
And there's really no way to bridge the gap.
Yeah, that makes sense. Oh, I had a question, a follow-up. Now it's gone. Oh, well. What do you want to talk about?
I don't know. We've covered middle age.
Yeah, that was a good one.
Covered paying off our kids.
I had an investing question. Damn it. That upsets me that I dropped that. Oh, well. It's a consequence of this format.
Yeah.
I should maybe have a couple questions written out, but
don't worry about it.
Yeah, thank you. I appreciate your permission.
What do you do? Do you edit around stuff or do you just run it?
No, I'll probably just leave this.
Yeah. I like that.
Yeah,
I like it when you leave it. I like the little dead spaces in interviews. I've actually, when I first heard about podcasting, I was like, this is such a stupid idea. It's so you're getting the worst. You're not like when someone goes on, Bill Maher's show, you're getting their best lines, right? That's supposed to be the idea behind it. But with a podcast,
you got 10 minutes.
Yeah, with the podcast, it's the opposite. You're getting all of it. And I was like, this is such a terrible idea. And then I started, I don't like to listen to them. I like to watch them. But I started watching them. And I almost can't go back to the other format because you're getting the best stuff, but it's kind of polished and it's kind of bullshit, right? It's a soundbite.
Yeah, well, that's the thing. And if you just get talking to somebody, you actually find out what they think.
Yeah, exactly. I find that so much more interesting. Like, looking at someone like Louis C.K., who's a really funny guy, I think he's so much more interesting in an interview than his stand-up is, or even his show was. I enjoy him more than the product.
Yeah.
And I enjoy that. And that's true for everyone I like.
Yeah, I think that's right. I think that's what's so powerful about podcasts is you get to know somebody.
Yeah.
It's amazing how many people want a podcast, myself included, by the way. But like, what a shitty business this is.
Well, right? It's a shitty business if you're only trying to make money off this. But if you have a fund or something like that, and you're kind of cross-pollinating it, then it's perfect.
That's right. Yes, it's a very good marketing vehicle. I still need to figure out what I'm trying to cross-pollinate. My problem is going back to our conversation about I don't know anything.
Mm-hmm.
I don't know how to sell shit that I don't believe in. So like I got to come up with whatever the other the monetization plan is.
Yeah.
I think events I would believe in. I think I'd be quite good at those.
I think you'd be really good at that. I think you'd be really good at that.
Well, I'm going to do a couple.
I saw that you emceed something at
yeah, that was fun.
Yeah,
Markel.
You're is that what it was for? But you're a natural for that stuff. I think that'd be really good for you.
We'll see. I like it.
You should put together.
It's nice to talk to people.
You should put together an event. You can get so many people who could talk.
Yeah, no, I'm gonna do that. It's some of it's a matter of right now. I'm in the process of figuring out what time of year and where. So basically the first planning stages. But I've been thinking about this a lot.
Florida in the winter.
Yeah, that's an enticing idea for sure.
But I bet you could get a lot of people. I think it'd be fun, and I don't know. People just want to go do something.
Yes, now they do. It's a consequence of being locked up for a little while, I think.
But I'd give anything for a good investing event. Even we went to that Fairfax annual meeting.
Yeah,
and that I loved hanging out with you guys, but the meeting was dull as dirt.
I'll tell you what I liked about that meeting was I didn't realize how many portfolio companies they have.
I didn't either.
And throughout the world.
Yeah.
But I thought Prem's pitches on certain ideas were kind of wild. Like the Greek bank that he was like, it's trading at 0.2 times book. And if it gets back to 1 times book, we're going to make a lot of money. It's like, yeah, Prem, that is how the math works. but let's talk about the whys behind that,
He's interesting because he sort of does both, right? They own Bangalore, part of Bangalore Airport or something like that.
Yeah.
But then they'll own, these garbage wood products businesses that are just, cyclical and a mess. But he gets them so cheap.
Yeah, they just got taken out of RFP.
Yeah.
Oh, one thing that we talked about last time that we talked, you've got like the deep value guys and then the quality guys. And I think with the commodity ideas, I think they're easy to know when to buy because they're just like so bombed out, but they're impossible to model the IRR. Mm-hmm. Because like something like on Resolute, they were objectively correct. I mean, a private buyer came out and paid a lot more, and they've been buying the whole time. But that took a long time. You know, that's a hard strategy to run. And it's almost like a macro commodity type call. But I don't know, like copper in 2016 was super easy to see. I bought, this is my problem with commodity stocks. I bought Freeport McMoran. I'm pretty sure it was December 2016. It might have been 2015. It was my last time at the bank, the last December I had. And it was so bombed out. Yeah, it was 2015. $4 a share. Today, well, $4.35. Today it trades for $31.41. You know what I made on that? Maybe 50%.
It's so hard. It's because I guess this is why we don't do a lot of that stuff. I mean, one, I just find it hard. I don't naturally understand it very well. But the other thing is I want to try to buy stuff where it's relatively easy to come up, or at least simple to come up with a forever value for the company.
Yeah.
And when it's not bounded by anything and it's just so, the variance is so big it swallows the mean, I really struggle with those things.
Oh, I like how you said that.
Thank you.
And when the variance swallows the mean, I think that you have to demand such a huge discount to what you even think it might be worth, because the probability that you're accurate in your assumptions is like super low.
Yeah, which most people don't do, right? They're more focused on trying to get the cycle right and all these things. But I would argue what would be better in a situation like that would be to get a bigger discount, which is basically demanding a bigger payoff.
Yeah. Yeah, that's right.
Which is actually, I would argue that's what Nassim Taleb was doing back when, he was trading, and how he became independently wealthy is that he was basically value investing in randomness. Where everyone would think oil's going to do X. And he says, well, what if it does Y? Well, what's my payoff? And he would be guided by the payoffs. He'd say, well, if it does Y, I make 20 times my money.
Yeah.
So let me bet on Y. And that only needs to happen, a certain percentage of the time. And you have a really interesting strategy.
Yeah.
But it was very payoff centric.
Yeah, which I think everything is. I got to follow up with Malbos, and he had expressed interest in coming in, and I'd like him to come on. But I haven't been ready to interview him. And one of the things that I've been thinking a lot about is with expectations investing, how do you implement that in a like real world way? And one of the things, like, you can say, well, like, there's so many elements that can go into DCF that I want to figure out if there's a way to have, like, I put in the balance sheet and the income statement, and the cash flow statement's going to flow from those two. But can I have something that gives me back a Monte Carlo simulation of like all the different ways that I could get to today's stock price?
Mm-hmm.
And then, like, obviously it's only as good as like it's garbage in, garbage out type stuff. But I'd like a visual representation of what a stock looks like. I think this guy, Jem Carson, who was on, would argue that that's what the options market is. But I don't know. I want to figure out if there's a computer program that would do that, because then I think you get to actually see the variance and see the mean. Now, it's going to be imperfect because it's the future, but it would intrigue me to see that. What does that sound like to you?
I mean, that's pretty interesting. Well, it's interesting because what you're saying, he's right. I would never put that together myself, but he's right that is what the options market does.
Yeah.
What would be interesting is if you could create a strategy by, using pair trades and things like that, where you could recreate the same thing using equities.
Yeah. I'm certain it's possible. I don't think I'm smart enough to do it.
But that would be, you're basically talking about each company is several different future versions, right?
Yep.
Probabilistically.
Yes.
But then the way to harness that and only bet on a certain part of that would be through a pair trade, right? Where you only want to bet on one or two of those versions that you think is interesting and you want to short the other part.
Yeah, and like which ones are priced well, right?
I actually think there's something kind of brilliant with that, right? Because then you're not paying theta on the options. You're not paying. You don't have to pay for the option. It's basically a costless option. You got to pay the interest on the short, but
yeah,
up until quantitative easing and zero interest rate policy, people actually used to make. I didn't know this. People used to make money on their shorts. You used to get paid. You get paid the interest.
Yeah.
The rebate rate used to be, like 3, 4, 5, 6%.
Yeah.
So it's like you structurally were making, it was a positive carry trade. Shorting was. I don't know, Bill. I think you're like splitting the atom. You're on finance here. I think this is kind of cool.
Yeah. I mean, one of the things that's really neat about the podcast is I get to talk to people that expand my brain.
Well, you just expanded mine.
Yeah. Well, it's all about sharing and learning, right? That's the whole thing.
I want you to throw an event. I'm all excited about this.
I will. The first one's going to be a golf event because I got to do something that I know I can do well and that I can do well. And then I'll get into it. I like it. It gives me energy. I enjoy seeing people. I will do one for sure. But I just gotta put it together, man.
But I guess what do you do? Is it you just have to rent basically a conference room at a hotel, and then you got to get speakers. And you got to plan basically 2 or 3 days of events and stuff, right?
Yeah.
Which is a lot of work.
Yeah. I don't want to give away too much of what I'm thinking. You do need speakers. I'm not sure. I'm not sure that I think that the idea of somebody telling people what they think is their best idea is the way that I would want to go with it. I think like roundtable discussions would be more my version of what I would want to listen to if I attended a conference.
What if it was instead of someone presenting their best idea, which I agree is boring, what if it's someone sharing, some part of their investing journey or something?
Yeah.
It's a little bit, it's investing, but it's more personal, which I think interests us both more.
Yeah, well, that's kind of this brand, right?
Yeah.
Yeah.
But that could be interesting. And maybe that in a roundtable setting.
Yeah, I think that's right. Just need to do it.
It's good. I think it's exciting.
The execution is always more important than the idea.
I know. I hate that. I hate that. Executing sucks. It's so hard.
Yeah. But, it's also what's really fun. And it's really fun when things come together.
Yeah.
So, got that going for us. So, what are you looking at? Like, what's your day-to-day look like now? What do you do? What would you say you do here, Scott?
Well, I've been really trying to market my fund lately. So I've been getting on Twitter and putting out research through Twitter and submitting it. I just had something published by Advisor Perspective.
Oh, nice.
Yeah. So I've just been putting that stuff out, and I don't know. I've been just investing, but the stuff we own, it's very, the day to day is boring. We hold stuff for a long time, so there's not a lot to do in terms of the day to day, and we only own 10 stocks. I'd like to own more.
How do you get comfortable with that?
There's actually a lot on this, where basically the benefits of diversification rapidly diminish after 6 stocks.
Yeah,
and so. We have about 25% cash right now, and then, the rest of it is in equities. I don't think any of it's in the U.S. It's all throughout the world.
Wow. Yeah. That's interesting. That's an interesting thing for somebody to consider from a diversification standpoint.
Yeah, I mean, I'd love to be invested in the U.S. I haven't found a single thing though that meets our sort of unofficial model.
There's got to be something.
I can't find big enough payoffs with a company that I think is, an inevitable. That's just an extremely high percentage business. I just don't. I haven't come across that.
So, what are some of the countries that intrigue you from that perspective?
China, which obviously has a lot of issues, and I'd say unlike Munger, I'm not sure I admire them to the degree that he does. Although it's great that so many people have been raised out of poverty, but obviously a lot of other things there are pretty horrific. And then just random places. It's more about investing in the company, not the country.
Yeah.
So, but we found stuff in China. We own Alibaba, and we own Great View Aseptic Packaging, which I think is actually a really interesting stock that's just been trades at a bombed out valuation. But that's something that's a good example of what we've been talking about, where it's got really good EBITDA margins for basically the last 20 years, and with inflation going on right now, its earnings have cratered, but it's a consistently profitable business. It's just going through a tough period, and it's just, you can basically buy it at almost the same price it traded at in 2004.
Wow.
It's kind of crazy.
How do you trust the numbers?
I mean, I don't trust anything. But to a large degree, yes, they return their market cap. So they pay a dividend, and they basically return their market cap every 13 years in dividends. Oh. So, could it still be a fraud? Absolutely. But does that reduce the risk? Yeah.
Yeah, it's hard to make a fraud out of dividends, right? You need some cash. I guess it could be a Ponzi scheme, but you need some cash.
Yeah, but they don't even tap the capital markets, so for financing. So they're not a creature of the financial markets. They've got very little debt. And then we own a telecom operator in Latin America. It's stuff like that. We're very sort of payoff centric and trying to go where we think those are really big, and we can be really wrong a lot and still come out ahead, and not be investing in things that are just a complete disaster and going to dig ourselves into a hole.
That's got to be exciting to have gone through the research, formulated. It sounds to me like this is probably who you're going to be for the rest of your life as an investor, and like to come to that part of a journey. That's exciting.
Yeah, I feel the same way. It means so much to me to hear you say that, because no one else seems to think it's that interesting. But to me, I think it's super so interesting. But but that's exactly how I feel. I feel like, I found something that just really fits my nature, and I think has worked for a lot of other people who I admire.
Well, that's a pretty good way to borrow brilliance, right? Go back, study their track record, reverse engineer what worked for them, and then do something that is different from what most people are doing. So now the rest is up to you to make sure that it works.
Yeah.
So you're just charged with the execution.
Yeah, the hard part.
That's right.
It's actually the same thing. I do the same thing with my writing. I have a select number of writers who I just really admire, and I love kind of researching their lives and how they write. And it's funny. It's very hard to write, and I'm always curious if there's some better way to do it. And I've realized, studying these other people, there is no better way. There's no shortcut. It's just this journey you have to go through, and there's no way to make it easier. There's no way to make it faster. You just have to do it. And there's something about seeing that, in the experience of other people as well as your own experience, that it's very powerful. That goes back to what you were saying. It's a high percentage belief. And as a result, you're not wasting time on low percentage, stupid things. You're not wasting your time on shortcuts. You're just trying to do the work. And there's something just so powerful about that.
I have come to believe that all the rewarding things in life are very hard, and many are very tedious. But executing that over time is where rewards come from.
It really is true. It really is true. And I used to believe when I was younger that if you were a fit for something, if your personality or your temperament were a fit for something, you wouldn't work a day in your life. Right? That whole thing, if you have a job you love, you work a day in your life. I think that is bullshit. I don't think nothing I've done that's worthwhile, I'm curious what your experience is, has ever worked out that way. It has always cost me something big time.
Yeah, I think that's right. And I think if something is not work, like there's going to be days that it's work. And, I mean, I think that when Buffett says that he tap dances to work, a lot of life, I think, is repressing the memories that you hated as you were going through them and then looking back at them as if they were roses.
Totally.
And, like, I highly doubt that when he was going to Solomon Brothers, that was like some fantastic experience that he tap danced to. He was probably like, motherfucker.
Yes.
Like, these guys are going to bring my ass down. So I think, I think that the work part of life is where the good stuff comes from. And if there's no crappy parts, then it's probably not worth doing.
Yeah. Yeah. I would agree with that.
I think that's a good place to end, man.
I really appreciate you having me on. It's a lot of fun. I've loved this.
I enjoy talking to you. You can come on anytime.
I'll have anytime you need someone, let me know. I'll hit you up in a few months to let me back on.
I may need a guest sooner than that. You may become a regular.
I'm around anytime.
All right. Well, hopefully less. Hopefully people discover your research and what you're putting out, and I ping you and you say, you know what, I got meetings that day. But if you don't, you're welcome to come on. And thanks for doing this now twice. I appreciate it.
I love it. And I can't tell you how happy I am that you've created such a great podcast.
Well, thank you very much, man. I'll try to keep it going.
Terrific. Thank you for having me on.
All right. Take care.
Take care.
But it's absolutely necessary.